All right, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Sam Lau here with Eric Dhall.
Hey, hey.
All right, Eric. It's just after 10 a.m. Pacific here on September 27th, the penultimate business day of the month. Pretty much quiet week here that we had in both the markets and the macro front. So I guess we'll just go ahead and kick it off. And we didn't get a topic of the week this week as well, so it'll be a pretty quick wrap up of the markets and the macro front. But I'll kick us off here with what happened with the S&P 500. The S&P 500 is up about 80 basis points on the week-to-date basis so far this week. Doesn't sound like much, but when I took a look at the daily moves here, it's just another week, another high, all-time high for the S&P 500. But this time made it a little bit different. We hit an all-time high on Monday, and then the next day on Tuesday we broke that record, and then again we hit another all-time high on Thursday of this week. So far the Wednesday was a little bit of a slacker there and not reaching an all-time high, and the day's a little bit young here. It's as you can, as indicated by kind of this 80 basis point week to date number, it doesn't take much to bring us to a new all-time high today. So we'll take a look to see if we can make it a four-way foursome, I guess I can call it that. But yeah, we'll see what happens at the close of this week. But right now, looking at it, we've got 8 of the 11 sectors on the week-to-date basis in the green. Leading the way is the materials sector, up almost 4 points on the week. Consumer discretionary up about 2.5%. And then on the flip side, we've got energy down about 1.5%. Energy certainly has been in the news here a lot, especially as people keep their eye on crude oil futures, but that's certainly having a drag on the energy complex within the equity component there as well. Healthcare also down about 1% on the week, and then rounding it all out, financials is down 30 basis points here in the final full week of September. Moving over to the fixed income front, rates had pretty much flat on the week, not much movement versus last Friday, but wow, on a month-to-date basis, we're really seeing a rally across the curve. Really kicked off by, yeah, both the expectations going into FOMC week with Powell, and then after the 50 basis points cut on the federal funds target rate, we saw the biggest move here on the short end. So on the month-to-date basis, the 2-year note is lower by 35 basis points. It's right now sitting at a yield of about 3.57%. The 10-year is in 15 basis points on the month with a yield of 3.75, and then the 30-year bond is in on the yield on the month-to-date basis by 10 basis points. Right now, it's sitting at a yield of 4.1%. So what that means is for the month so far, very strong performance for the Bloomberg U.S. bond aggregate. That's up about 1.6% on the month-to-date basis. On the week-to-date, it's pretty much flat as well, as indicated by the pretty much unchanged across the yield curve for the week-to-date on the treasuries there. But leading the way here, it looks like we might have high yield leading the way. It's up about 5 basis points. It's pretty much flat on the week-to-date. Bank loans pretty much flat on the week on the week-to-date, as are agency mortgage-backed securities and U.S. Treasuries. However, one laggard within the complex there is the IG corporate credit market. That's down about 20 basis points or so on the week. So overall, just a pretty even week across the fixed income market so far. Moving across the commodities struggling if you're looking at it from the WTI crude oil futures perspective. That's down 5% on the week-to-date basis when we're looking at the front contract of WTI crude oil. That's down below $70 again. That's at $68.50, let's call it, per front month contract of WTI crude. All of it's a little bit bewildering, given the step up in the geopolitical news that we've had over the past week. But right now, as we've been talking pretty much all year, Eric, it's just been the seesaw between supply and demand factors within WTI crude oil. And right now, it just seems like the supply side is expected to be a little bit in surplus relative to demand. So we'll see how this pulls out. But right now, we're at a $68 handle for WTI crude oil. And then when we flip over to gold, gold dropped below the 2,700 per troy ounce mark, but still up a percent on the week. But right now I'm seeing it at a troy ounce of $2,650 per front month contract of gold there. So with that, the Bloomberg Commodity Index was able to pull out a positive week. Pretty strong week, actually, up 2.5% on the week-to-date basis based on the Bloomberg Commodity Index, and that brings the year-to-date performance to a positive 6%. So with that wrap up of the markets, Eric, do you want to kick us off on what happened on the macro front?
Yeah, definitely. Gold's kind of got some luster right now, and it's interesting. We'll have to wait and see what happens. The markets are, it kind of feels like the markets we were discussing earlier are in a bit of a Fed hangover, maybe a bit of election purgatory, as the markets wait to see what happens come the first week in November. And everyone is just kind of waiting with bated breath. From a macro perspective, pretty, pretty as expected week, I guess I would say. The S&P Global Manufacturing came out on Monday and it came out at 47, and that's a decline from the prior 47.9. 3 months in a row it's been below 50 in the contractionary territory. So, I remember back in 2014 there was the manufacturing recession with no broad, economic recession in the United States. So maybe maybe the soft landing or no landing, folks, that's what they're hanging their hat on. They think there's going to be a 2014 repeat of just a manufacturing recession, but services are going to pull it out. And the S&P Global U.S. Services PMI came in at 55.4, slight decline from the prior 55.7, but that marks 20 months in a row where it's been above 50. So services are still strong. That aggregating those together, we get the S&P Global U.S. Composite PMI came in at 55.4, a slight decrease from the previous of 54.6. So pretty good numbers from the services side. Manufacturing's hurting, but that's been that's been the case for the last few months now. The U.S. housing market remains resilient, growing again in July. On Tuesday, we got the S&P CoreLogic Case-Shiller 20 City Index, and it printed a growth of 0.27%, which was beneath the prior of 0.47%, but still positive growth. And that leaves the year-over-year index up 4.96%. If you look at on the headline level, if you look at the 20 city index, which is the largest cities, it's up 5.92% on a year-over-year basis. So pretty nice return in U.S. housing. Not really growing like gangbusters like it was a few years ago, but still beating inflation and getting house owners and property owners a real rate of return there. Consumer confidence dropped on Tuesday and they came in at 98.7. The prior was 105.6, so that's a drop. If you look at the present situation, it came in at 124.3. The prior was 134.6, so it dropped there as well. And expectations dropped from 86.3 to 81.7. So consumer confidence definitely had a weak print. Maybe, consumers are starting to get a little iffy now that the labor market is getting back in balance. We get the jolts next week, and if you're looking at the amount of jobs out there per person looking for a job, it's close to one. So, maybe that's starting to weigh on people's mind, the cost of living. I'm not sure, but the numbers are the numbers. The consumer confidence numbers dropped. We got the final third estimate for Q2 GDP, and it came in above what economists thought it was going to be. It came in at 3%, which was the same as the second estimate. And the third estimate is usually the final, like, major revision. And sometimes they'll do annual revisions after that, but that's so Q2 GDP in the United States was up 3%, which is quite good. And Thursday, we also got durable goods, came in flat at 0, which was a big drop from the previous at 9.9. That said, this was expected. And when you take out durable, when you look at durables X transport, it was up 0.5%, which was a positive number, better than the previous of minus zero point 0.1. And if you look at cap goods, non-defense X air, it was positive 0.2%, which was better than the prior of minus 0.2%. So, looking at it in totality, probably like an okay print, not like an alarm bell print. We got initial jobless claims as well, came in at 218,000, which was very similar to the previous of 222,000. Same story with continuing claims, came in at 1,834,000, a little bit above the previous of 1,821,000, but well within the standard volatility you'd expect. So no new information there. And then on Friday, we got some kind of important data prints, but they came in pretty much as expected. Nothing too shocking. Personal income came in at positive 0.2%, which was a little below the estimate of 0.4%, but the prior was 0.3. So, you know, in the range there. Personal spending came in at 0.2%, which was a dip down. So if you're kind of have a bearish inclination and you're looking for a data point to hang your hat on, maybe you're going to harp on the personal spending being down. That's always this, the US being a services driven consumer economy, 70+% of the economy, spending is a very important variable to watch. So that 0.2% there was below the estimates of the market. And I mean, if you dig into the details there, um, good spending is a third of the basket, and it was down. The contribution was minus 0.12%. If you look at services spending, which is two-thirds of the basket, it was up and 0.4%. So that was a 0.28 contribution. So once again, this is kind of reflecting that broader narrative that maybe we saw in the PMIs, where the services part of the economy is doing well, but people are kind of tapped out on goods and they've maybe have price fatigue. They're not looking to buy that next TV. That's at least one way of looking at that print. And then finally, we got the PCE price index, which is a very important indicator, but one that was pretty much well understood because a lot of the feeding data was well known going into the print. And the PC price index on a month over month basis for August came in at 0.1%, exactly on the estimate of 0.1%, below the prior of 0.4. And you saw a pretty nice rally in fixed income after this print. Even though it was expected, the market was always, walking on eggshells before a big PCE print. Because if it surprises to the upside on inflation, it's going to crush bonds. But we didn't get that at all. We got it right on what the market was expecting. If you look at on a year-over-year basis, it's at 2.2% headline, below the previous of 2.5. Now, going to core PCE, which strips out food and energy, which are more volatile, with energy prices down, obviously that's dragging the headline number down. Month over month came in at 0.1%. The prior was 0.2%, so a positive print there from a inflation fighting standpoint. But it still leaves the core PC price index on a year-over-year basis at 2.7%, which is a little higher than the prior. And a lot of that has to do with the owner's equivalent rent and the way that that basket has kind of, remained resilient. And, rents haven't really rolled over in the samples that they've used. And so that's an area of, where the inflation fight is still happening. The Fed has confidence that it's going to abate as time goes on, but right now, with the housing market still strong, and I think that's an area to watch still. And that kind of wraps us up for the week.
Yeah, so with that, I mean, I think the today's print of PCE pretty much gives the Fed some more, additional comfort in terms of what they're seeing on the inflation front and hitting their trajectory that they like to see. Just gives them a little bit more to be able to just put their focus on the labor market, which I think has been as you mentioned before, the weak point, right? This is what the Fed has been perhaps more concerned on, of the dual mandate between inflation and full employment there. So I do think that they got a little bit nervous with some of the more weak data that they've seen over the past few months in the labor front, especially when that big revision came out for the 12-month annual revision on the BLS payrolls report when that was revised down by 818,000 over that last 12 months ending March of this year. But it was something that when we saw the summary of economic projections for this most recent FOMC meeting, what really stuck out to me was the fact that in June, the expectation for the dots was that there was going to be 125 basis point cut for the year. Then now between you fast forward 3 months to the next FOMC meeting that we just had, and all of a sudden it's talking about 100 basis points of cuts. So something increased it by 75 basis points. So right now, when we take a look at it, that to me that's just the clear standout there is the labor side. But when we look over at what the market is projecting for the Fed funds futures probabilities, right now the market is kind of fighting the Fed when I look at it right here, because we had the 50 basis point cut in September. And then now between now and year end, we have two meetings, one in November and one in the middle of December. And the market's pricing in 75 basis points additional cut. So they're saying that the Fed projections, as indicated on the September summary of economic projections, is a little bit too low. So the market's wanting a little bit more, at least based if we take a look at this measure here. So as I see it, you've got it's basically a coin toss in the November meeting whether or not it's going to be a 25 basis point or a 50 basis point cut, and then the remainder is priced in for the December meeting there. So again, right now the market through these Fed funds futures looking at 75 basis points additional. So we'll see what happens. There's a lot of data points between now and the November meeting for the Fed to digest, but I'll be keeping an eye on just the employment data that comes out. With regards to things to keep an eye on for next week, on Tuesday, October 1st, we'll have the JOLTS job openings data. So an ever important number there as the Fed continues to focus on the labor front now. But right now, the estimate is for the number of job openings to increase by 20,000 to just shy of 7.7 million job openings there. And then the ISM manufacturing component is expected to remain in contractionary territory, just up, improving slightly to 47.7 there. So from the previous month. So we'll see if that manifests there. But as you mentioned, there continued weakness that we expect to see in the manufacturing front as this kind of goods recession or not goods recession, but the slowdown in goods spending perhaps is translated through this ISM manufacturing component there. And then on Thursday, we have the counterpart to that, which is the services side. That's expected to remain flat in expansionary, flat over previous month at 51.5, but remaining in the expansionary side of things for that survey. And then on Friday, the ever important labor data that comes out for Pizza Friday, the first Friday of each month, is when we get the non-farm payrolls as well as the unemployment rates. So both the establishment and the household surveys. On the non-farm payrolls, we're expected to see 8,000 fewer payrolls created in the month of September. It's expected to tick down from 118,000 on the initial print for August down to 110,000 for the month of September. So we'll watch to see whether or not we get a beat or disappoint on that month for September. But as we've been talking about here on the minutes, we'll also be keeping an eye on the revision to the prior month's payroll data as well, because that has been the trend where you do get a beat on the initial data print, and then on subsequent months revisions, you see that number come down pretty materially. As for the household survey side, we'll have the unemployment rate come out, of course. That's also expected to be flat at this point at a level of 4.2%. And then finally, for the labor force participation rate, that's also expected to be flat at 62.7. So not much of a projection there in terms of the household survey side, all those remaining flat. But that pretty much wraps it up for this week. For those of you who like to watch our YouTube videos, we have Jeffrey Gunlock speaking with the folks over at UBS, where he'll be talking and giving an update on his views on the market as well as the macro front. So be sure to check that out.
Thanks to all our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com if you have any questions, comments, or suggestions.
Yeah, want to thank everyone for tuning in. Don't forget you can find us on the interwebs at doubleline.com, or don't forget to subscribe to us there at the YouTube channel as well. I hope everyone has a good weekend and good luck out there.